Good morning, good afternoon, or good evening to everyone, wherever you are. I'm delighted to be with you here today for a session that will explore better data, risk assessment, and disclosure in what is an interesting period for the emerging discipline of sustainable finance. I'm joined by a group of leaders at the forefront of developments in this field who will hopefully help demystify a few things at the time that we have, recognizing this is a huge and rapidly evolving area. For those of you that don't know me, I'm EY's Global Vice Chair of Sustainability, and I've been in this role since July. It's an incredibly exciting journey so far. I've spent most of my time listening to our clients around the world talk about their vision and then helping them take advantage of the huge areas, huge opportunities in this broad area of sustainability. Some of you may know that EY's purpose is building a better working world. We exist to increase confidence in capital markets, which we do using the established metrics and frameworks of financial reporting, evolved over the last 100 years or so. As a profession, we have a long history of assuring financial reports and developed a good track record of navigating between different global and regional financial standards. I think we all appreciate that over the past decade or so, we've seen an explosion of interest in non-financial reporting. This has largely been in response to increased societal demands for greater transparency on the wider impact of business and the need to rebuild trust. Investors too are asking for better data, more disclosure, a consistent methodology and approach to reporting. EY's own 2020 Global Climate Change and Sustainability Services Institutional Investor Survey showed that 98% of respondents want to move to a more disciplined and rigorous approach to evaluating companies' non-financial performance. And 91% said that non-financial performance has played a pivotal role in their investment decision-making over the past year. There is a growing body of evidence and a very lively debate that indicates that sustainable finance, and by that I mean finance that incentivizes the integration of long-term environmental, social, and governance criteria into business decisions, is a positive driver in creating long-term value for all stakeholders of a business. Together, we're collectively searching for a constructive way forward that will increase confidence, help businesses make better decisions on capital allocation, and improve risk assessment and reporting, and help investors make better, more informed investment decisions. But we do all this swimming in an alphabet soup of frameworks, standards, and initiatives, all of whom have played important roles in different parts of the ESG and LTV movement. It probably won't surprise you all to hear that there are now more than 1,700 ESG-related guidelines, including over 360 different accounting standards. At EY, our job is to try and make sense of it all. We believe capital and talent will shift from organizations that only create value for their shareholders to those that create value in the long term across a broad range of stakeholders, including employees, consumers, society, and shareholders. It's not an or, it's an and. Companies that focus on effectively on long-term value creation for all their stakeholders create better value for shareholders. They are more valuable and viable in the long run. At the end of September, the World Economic Forum's International Business Council released a suggested set of core ESG metrics in a white paper involving a collaboration of the Big Four, a collaboration that is testament to how seriously we, the Big Four, take this challenge. I think we all realize we're at a pivotal point in the genesis of sustainable finance. I'm delighted to have some of the leading lights in this space with me here today. So let's hear what they have to say. Now, can I ask each of the participants to give a 2 to 3 minute opening, both introducing themselves and setting out their position, and then we can start a Q&A. And to be helpful, can we go in the following order of Janine, then Val, Ewout, and then Joe. Janine.
Great. Thank you, Steve. And that was a terrific introduction. So thank you very much. I'm Janine Gilliatt. I am CEO of SASB. About how do sustainability disclosure standards achieve the same legitimacy as financial accounting standards? And definitely want to spend some time today talking about that. But to give you a sense of my background, I joined SASB after a career in investment management on both the asset owner and asset management side at CalPERS and Barclays Global Investors. But very importantly, I started my career as an auditor in accounting, and also spent some time in on the issuer side in external reporting early in my career. And so I really do, what I find so interesting about this conversation at this point in time is how do you bring together all of those perspectives? The issuer perspective, the investor perspective, the accountant and auditor perspective. So I'm really excited to be on this panel today.
Great, I can pick it up from there. Hi, everybody. I'm Val Smith. I'm Citi's Chief Sustainability Officer. And it's really great to be on this panel with you all. I'm actually looking at you all and realizing that this is a set of some of our closest partners from our work with EY on the TCFD disclosure effort with IIF to Joe and Bank of America, which is a competitor of ours, but also one of our closest collaborators in climate policy and some of the other areas. And obviously about with S&P, looking at them as a great data source for some of this work. And Janine, we are not yet a SASB reporter, but we are taking a close look at it. So looking forward to learning more from you. So my team at Citi is focused, the sustainability and ESG team is responsible for developing Citi's overarching sustainability strategy across our different businesses, across our regions. We recently announced a 2025 Sustainable Progress Strategy, which really looks at sustainable finance through multiple lenses. The first pillar being our low carbon transition efforts, and including a $250 billion environmental finance goal. The second pillar around climate risk, which I think we'll talk more about on this panel. And the third pillar around our own sustainable operations and continuing to set some challenges for us in that area as well. In addition to the work that I do with Citi, I also work closely with IIF and on the Sustainable Finance Working Group, and specifically working on the TCFD disclosure tool, which we can get into further. I think that, this area around disclosure is so important and is also evolving quite rapidly. I'm sure, Steve, when you began your career, you didn't expect that, accounting and assurance and disclosure would be quite the hotbed of activity that it is today. I think that what's exciting about this place is not only our ability to more rapidly provide disclosure for investors and other stakeholders, but also how we're seeing good disclosure really help to drive performance in really important areas like climate change. So looking forward to speaking about it further.
Thank you, Val, and good morning, good afternoon, good evening to everyone. Steve, thank you for hosting this panel, and I'm really delighted to be part of this. My name is Ewout Steenbergen. I'm Executive Vice President and Chief Financial Officer of S&P Global. S&P Global is a key data and analytics company for the financial markets and the commodity markets. We run our business through 4 divisions. Obviously, the ratings business that everyone knows. Then we have our index business. This is the S&P Dow Jones Indices business that helps asset managers with passive strategies and providing specific indices. Then we have our market intelligence business that provides data and analytics through desktop platforms as well as data feeds. And then we have our 4th division that is called Platts. That is a commodity markets benchmark pricing business and analytics business. When we think about ESG, we always can think about it from 2 different angles. It's the angle of how can we help market participants with better information, more transparency, more standards around these ESG topics. And all of our businesses are involved in this area. Actually, that's why we are so excited about this particular topic, because all of our businesses have a role to play in helping market participants. From Platts, that is active with energy transition, to the ratings business that is already including ESG factors in the credit ratings, but is also having other products like ESG evaluations and green bond evaluations. We have our index business that is launching a lot of new ESG indices, and many large asset managers in the world are now adopting those indices. So we will probably see a very large acceleration of that in the near future. And then our market intelligence business is having a couple of very important subdivisions. Think about TrueCost, which is one of the most prominent environmental data providers. And we also did an acquisition of a company called SAM, RobecoSAM, the ratings, ESG ratings business of RobecoSAM. And that's a business that's already in for 20 years collecting ESG data through surveys, because time series is really important in this area as well. So that is what we do, and I would expect us to do even more and more in the future around this topic. But when we think about ESG, it's also what we do ourselves as a very large corporation. And I'm personally very active around this, very passionate around this. We're following a couple of standards, TCFD, CDP, GRI. There is a network of CFOs called the Accounting for Sustainability Network, which is endorsed and sponsored by the Prince of Wales, where CFOs from Europe and in the US and Canada and other parts of the world are coming together, because CFOs can really drive this topic in terms of better disclosures, more transparent disclosures. And we are trying ourselves as a corporation to really push the boundaries in this as well.
Great, thank you. Hello, everybody. I'm Joe Goodwin. I am the Strategic Initiatives Executive for Bank of America, which means different things at different times, but one of the most salient for now is meant for the last years. I have been working very closely with the IBC, World Economic Forum Task Force, with the partnership of the Big Four accounting firms to help identify the key stakeholder capital metrics for non-financial disclosure. And it's a real pleasure to be with this group, because I think we all have a shared understanding of the importance of non-financial disclosure. Because, you know, we sometimes hear that companies such as ours and others must choose between sort of Milton Friedman's primacy of shareholder capitalism or a broader view of stakeholder capitalism. Well, I know at Bank of America, I know Valerie, you as well, we reject that false choice. Exactly as what you said earlier, Steve. It's not an or, it's an and. The simple fact that at Bank of America, we really believe we must continue to deliver great returns for our shareholders and help drive progress on societal priorities. And there's really ample evidence more and more to suggest the wisdom of this approach. I mean, our Bank of America Global Research Team, which has been ranked in the top one for 7 of the last 9 years, has published a series of research reports demonstrating that companies that really do pay close attention to ESG priorities are less likely to fail. And now there's growing evidence that, in fact, especially given the context of the current crises, those companies actually outperform those that do not. So we have always been committed to non-financial disclosures, to embracing the concept of stakeholder capitalism. I mean, in addition, we do report on SASB, 5 of the 5 standards that apply to us. Janine, we worked very closely with you over the years to make sure we do that. We report on the UN Global Compact, the Global Reporting Initiative, the TCFD. We issued our first one this year. We do a proprietary human capital management report and an ESG performance data summary. All of this to say that we as a company are committed to sustainability. And we think what that means is that we need to bring our entire balance sheet to bear to the task. The $53 billion we have in expenses, the $260 billion in equity, the trillions of years of capital that we raise for our clients, because we truly believe that if all operating companies continue to align themselves to deliver on ESG priorities, as evidenced by the SDGs, on which they can have the most impact, and if we measured ourselves to be sure that we are making progress, we can deliver the capital, the creativity, and the expertise needed to really address the world's most pressing problems. So I'm really privileged to be here with all of you.
Great. Well, thank you, Janine, Ewout, Val, and Joe for that opening. Sounds like we're going to have a great session. And can I just remind everybody that's watching us, if you use the technology, feel free to ask questions. I'll pick them up through the moderator panel, and I'll put them out to the group here. So please engage with us and we'll go from there. But let me get it started off here. So let me come first to you, Janine. Now, 341 companies have reported SASB metrics this year, and 42% of these have been outside the US. Why have US SASB seen such high levels of adoption over the past 6 months? Share that with us, please.
Yeah, so the rate of adoption is rapidly growing, and that really is due to increased investor demand. So SASB from day one was designed around the needs of investors, which is for industry-specific data that is explicitly linked to financial performance. So, and metric-based, with the idea of how do you get comparable, consistent, and reliable metrics in the hands of investment decision makers. And so as investors are increasingly trying to integrate ESG factors into investment decision making in some sort of a rigorous, scalable, cost-effective way, the SASB standards are uniquely designed to enable that. They're also designed to enable, particularly for large pension funds who are trying to integrate assets, ESG across multiple asset classes, particularly private equity, public equity, and debt. The SASB standards can be used because they're industry-based, provide a very useful insight into company level risk, regardless of whether that company is raising capital in the public markets, private markets, debt or equity markets. So because of that, we have a very strong global base of investor support for the SASB standards, and they are being increasingly vocal about that. The most significant indicators of that were in January of this year, where both BlackRock and SSGA, in their annual letters to boards of directors and CEOs, encouraged use of the SASB standards along with TCFD. So it's that investor interest that is driving that rapid rate of adoption of the SASB standards.
Well, it just feels to me, Janine, that US SASB, the whole team, are on a real roll here. And as you say, the investor cheerleading that you have at the moment is, I think, really driving the adoption up. And your use of a sector-specific approach, I think, has been part of the key to your success as well. Let's stay on this area of reporting and standards. Joe, let me come to you. You mentioned your involvement in the World Economic Forum IBC work. So when that white paper was launched last month, you'll know your CEO, Brian Moynihan, said that a staggering $2 trillion of private sector investment is going to hit the UN Sustainable Development Goals. Now, I know you work closely on the report and have been involved from the beginning. Could you tell us about your thoughts on the role finance is going to play in this, and the recent report, and how also it will work with SASB and other initiatives?
Sure. I mean, so I'll back up a little bit. So I have been involved in sort of the work of the World Economic Forum and the IBC with your partnership as well as Steve at EY, not quite since the beginning, because it probably started in 1973 when the original Davos Manifesto was released. And that really established the principles of stakeholder capitalism and long-term value creation, like Janine's seeing with her investors, by realizing, like we said earlier, that companies that can deliver great shareholder returns and address the needs of society are going to perform better in the long term. In 2017, the companies of the IBC, of which my boss, the chairman and CEO of Bank of America, serves as the chair, signed and issued what they call the Compact for Responsive and Responsible Leadership. And that defined long-term value by aligning our progress to progress on the SDGs and more broadly on ESG goals. So then in 2018, the CEOs of the IBC came to us and said, hey, listen, we need to agree on a common method of measuring progress on stakeholder capitalism so that we can align the companies with the asset owners, asset managers, and other stakeholders on the common desired outcomes. So then last summer in 2019, the task force was created. And the team was very clearly directed not to develop a new set of metrics, but instead to begin the work to converge existing metrics into common, transparent baselines that could apply across industries. So basically, we were tasked to look at and identify existing metrics that we thought serve as the best proxies to communicate commitment to stakeholder capitalism. So Klaus Schwab, who's the chairman and founder of the World Economic Forum, secured the commitment of each of the big four accounting firms, EY, Deloitte, KPMG, and PwC to begin to identify what we thought were these universal ESG metrics. The first draft of that metrics was released in Davos of last year. And then between January and July, the team conducted extensive consultation process with IBC companies, non-IBC companies, investors, standard setters. Janine, you hosted a fair number of conferences with SCLT with us and other key stakeholders. And then at the summer meeting this year, we sort of presented the refined set of metrics, 21 core metrics, 37 expanded metrics, and they attracted strong support from the CEOs of the IBC companies, with the majority signaling their willingness to report sometime in a time frame that makes sense to them in the near future. But again, I think it's really important to say that this work we've been doing is not around a new framework or a new standard. You know, like I said, we drew upon the existing one. That's GRI, that's SASB, that's TCFD, Carbon Disclosure Project. Don't want to duplicate work, but you know, to help drive the convergence that Janine's been working on so well around, and our goal was really just to curate the smaller common set of industry agnostic comparable metrics. Because you know, we all believe, the CEOs of the IBC companies believe that stakeholder capitalism is an important concept, but we need a way to measure it. And we know the long-term viability of a company depends on its understanding of its stakeholder capital, stakeholder impact. So we'll talk more about the convergence that's happening in the ecosystem. I'm sure it's fantastic to see them. What we really want to do is not replace anything, like I said, but reach out to companies where they are and ask them to maybe do more than they were doing. It's not going to prevent us. I mean, like I said, we report extensively on SASB and other frameworks. We'll continue to do this, but this is sort of a baseline for people who are maybe not as mature in that space to get started.
That's good to understand, Joe. So this was a creation of a baseline to help companies start. And I think the backing of not just the big four firms, and I would say that, wouldn't I? But basically some of the largest and most important companies in the world, such as Bank of America and many others, has been really, really important to, once again, elevating this as a topic for discussion in the boardroom. And then let me pivot and bring Val in. So Citi, who may not yet be a SASB user, but maybe Janine, we can chat to Val offline about that. So let me bring Citi in. So Val, Citi launched your 2025 Sustainable Progress Strategy to help accelerate the transition to a low carbon economy. Now, this included an incredible 250 billion environmental finance goal to finance and then facilitate climate solutions globally. Can you tell us a bit more about the ambitions and motivations behind this?
Sure, happy to. And why don't I start with the why? Citi has been engaged in the sustainability space since 1997, when we started to look at and understand the intersection of environmental issues and finance. So we, you know, were pulled into this space pretty early on, pulled into the disclosure space very early on as well. We started, you know, disclosing on what we now call ESG in the year 2000. What led to our development of a more cohesive sustainability strategy framework was really, I think, you know, a number of factors. It was a sense that, and this is our second generation strategy. So in 2015, we launched our inaugural Sustainable Progress Strategy, organized also across 3 pillars, which we have updated. And it was this sense that by pulling together the different sustainability related initiatives that and ambitions and policies and targets that we had established as a firm, we could make sure that those were all sort of relating to each other, that the whole is greater than the sum of the parts. And so it was with that sort of understanding and frankly, you know, the value that we've realized from the previous strategy was just the importance of signal setting. We thought it was going to be mostly signaling externally to our clients, primarily at that point, this is 2015, and then to our investors. What I think we didn't fully understand was the importance of this signaling internally, that it really both gave our executives, you know, a cohesive, clear framework and set of targets to grab onto, but it also sent signals internally. And so as we were developing our strategy, the 2025 strategy, so just a 5-year period of time this time that we launched in July, it was a very different process. You know, it went from trying to convince our business partners to, to think about our ambition in a certain space, in a certain business, to people really wanting to be a part of it. And, it's been a great mechanism, so sort of for forcing more ambition for the company. And what we've done is essentially approach the sustainability and climate change space through multiple lenses. So, the first pillar with our low carbon transition and $250 billion environmental finance goal over 5 years really focus on the opportunity space. The second pillar around climate risk really focused on the risk management space and the analytics around that. And by the way, hopefully those are interplaying, right? As you are helping your clients to manage down risk and transition, there are more financial opportunities in the green side that come out of that. And then the third area, which I mentioned earlier, around our own sustainable operations, our 7,000 facilities in 97 countries, where we are, seeking to lead by doing as well in terms of our own ambitions there. And I want to sort of touch on a point that I think that is starting to come through that's really important, and it's around sort of the power of disclosure and the power of metrics. And it is very much a part of our sustainability strategy to inform the strategy development through stakeholder and client and investor engagement. And in fact, we had 2 dialogue sessions, half days in 2019, where we pulled together investors, we pulled together clients and stakeholders to give us feedback on our path forward. So it's very much around that engagement and disclosing on how you're doing. And, we've sort of talked about non-financial disclosure. I think that, we're sort of moving into, sort of a pre-financial or extra financial disclosure terminology, because I think it's becoming so clear, even on this panel, that a lot of this disclosure and metrics are helping to drive financial decisions. And so, it's part of our job, I think, to connect all of those dots. And sort of to land this, I think that disclosure, and particularly as we'll talk further, disclosure of metrics, through SASB, through TCFD, other disclosure frameworks as well. I think that level of transparency is really going to be transformational for our sector and the financial sector, but also for our clients. Once you have radical transparency out there, it changes behavior. So happy to speak further, but I'll turn it back to you, Steve.
Great, thanks, Val. So I think everybody, we've heard from 2 banks now in Joe and Val. Why don't we lift up a level and think about capital markets as a whole? And let me come to you, Val. So I've seen some estimates that the value of ESG-driven assets could top $45 trillion by the end of this year, with the Bank of America, our friend Joe, predicting a further $450 billion of green, social, and sustainable debt to be issued in 2021. So earlier this summer, you at S&P identified that ESG funds have performed better in the current downturn than the S&P 500. So please share with us, what are you seeing with capital markets moving in this direction? How are investors behaving and taking advantage of this broad area of ESG reporting?
Yeah, thank you, Steve. A couple of thoughts that I want to share on this topic. There's clearly one element that is related to the geographical trend, because we have seen first companies, capital market participants in Europe starting this trend already several years ago. And that has to do with the institutional investor environment in Europe, the company or industry pension funds, particularly in the Nordics, in the Netherlands, and in other countries that really wanted to jump on this trend because they thought it was important to do investments and take investment decisions with a certain purpose. We're shifting it to Asia. To give you 2 examples, the GPIF, the Japanese government pension fund, clearly has adopted strategies around ESG, and a company like Temasek in Singapore, very interesting what they are doing. They haven't segregated some assets and said, okay, this is an ESG strategy, and can we keep the rest the same? They have said fundamentally in every security selection, we're going to look through particularly an environmental and carbon lens, and that will determine the securities that we ultimately include in our portfolio. So a very fundamental bottoms-up approach that has been taken there, and very encouraging that we now see also in North America this becoming stronger and stronger. Second comment I would like to make is that in my expectation, COVID is only going to accelerate this trend because COVID is helping particularly better define the S. The S element of ESG was so far the least well defined, as most people know. And the current period puts a spotlight on how companies are treating their employees, how they're helping them through this period. They're thinking about supply chains and supply chain risk. So clearly the S is going to be better defined, and that's why I think this is only going to help with an acceleration. I would like to endorse what Val was saying about metrics and disclosures and the importance of this. And the way how I think about disclosures and metrics is three different levels. We have the more operational metrics. Companies can disclose reduction of paper usage and single-use plastics. You have the second level of disclosures, which is the more sophisticated frameworks, and very happy to see the standard setters coming together and the big four accounting firms coming together. But I think there's even one level above that, and it is integrated metrics. Can we integrate financial metrics with sustainability metrics and bring that together and look at it in an integrated way? We published our second TCFD report a few weeks ago, and we have tried to experiment with that. And we have a new disclosure, what we call carbon adjusted earnings per share. And why I like that particular metric is earnings per share is a very important metric for most companies, how they disclose their financials every quarter, every half year. And what we have done is we have further adjusted our earnings per share based on a hypothetical cost of carbon for our scope 1, 2, and 3 emissions. And therefore, we have now a carbon adjusted earnings per share. And why I like that is because now you have a key financial metric and a sustainability metric combined here together. I think with respect to outperformance, Steve, yes, I think we have seen outperformance of ESG strategies. I think that's very encouraging. To give an example of that, the ESG version of the S&P 500 has outperformed the classic 500 by 2.5% points through September of this year, 2.5% points, which is a significant outperformance. I think the experts are still not completely sure what is driving the outperformance. Is that because there is a reward from the financial markets for better performing companies with respect to sustainability? Or is it because companies that are focused on sustainability have better management? They are more holistically looking at value creation for the company, and because they have better management, there is also outperformance. I have a big hope that over time, with capital markets moving more in the direction of more capital going to ESG and sustainability strategy, that ultimately it will drive the cost of capital down for companies that are doing well, and therefore we will see ultimately over time a change of behavior.
Thanks very much, Ewout. That's fascinating, this whole area of cause and the correlation between those points. I know is a huge part of a very live and very important debate that's going on in the world at the moment. Let me come to Janine, and I'm actually going to go to Val in a few seconds as well, and ask you about Citi's investment strategy. So maybe Val, how you bring these things alive. Janine, Ewout mentioned integrated metrics, and then introducing in his organization a new variant on carbon and earnings share. What's your view on integrated metrics, and talk to us about that in the context of SASB and what you're trying to do overall?
Yeah, so I think all of Ewout's points are fantastic. And before I go to the metrics, I want to come back to something really important that he said, because When I led development of the investment beliefs when I was at CalPERS, and those beliefs said we want to integrate ESG into investment decision making across the fund because we believe that ESG factors were connected to risk and return. And sometimes when people talk about ESG integration, they really focus on explicitly labeled ESG strategies. That's important, but those are always only going to be a subset or a slice of a typical large fund's asset allocation. So at the end of the day, the real end goal is how do you think about integrating ESG into decision making across a multi-asset class fund, because that is how you influence the allocation of trillions of dollars. So I think that's a very, very important point. And the reason I joined SASB is because the only way you can influence the allocation of trillions of dollars is with comparable, consistent, and reliable information that, to Ewout's point and Val's point, is metric-based and connected to financial performance. That is what will influence the allocation of trillions of dollars. And so how, at the end of the day, do we get that level of comparable, consistent, metrics-based information? The way we've achieved that in the traditional financial markets is with financial accounting standards. And so using that analogy towards the same end for sustainability disclosure is essential. So that's a little bit of context for why I think standards play such an important role. And in order for them to really be effective, ultimately, we do need this last mile, which is the connection to financial performance. And that is where I see most of the cutting edge thinking being done today. SASB builds what I call a logical or qualitative link to financial performance. How conceptually does waste management in a consumer goods company linked to financial performance? Does it influence revenue? Does it influence expense? Does it influence valuation of assets or liabilities? Does it influence cost of capital? Our standards, we think through, okay, where is this issue likely to influence the balance sheet or the income statement? We don't quantify that link because that we view as the role of companies themselves, analytics providers like S&P, the asset managers themselves. And I think the real cutting edge thinking is being done about tools and methodologies for quantifying that link. That's also where there's room for a lot of proprietary analytics, because just like standardized financial metrics may be reported by a company, but all the different buy-side and sell-side firms will then reach their own conclusion about how that connects to future value. That same proprietary thinking is increasingly being done around sustainability metrics. So I think that work about that last mile and quantifying the connection to financial performance in a really rigorous way is where the field is right now. It's really exciting.
That's great, Janine. And now let's try and capture that and talk to the users. So maybe Val, in the context of Citi being a user of this information, because when you look at Citi's own investment portfolio, how do you actually use non-financial report standards and frameworks to align with your sustainable progress strategy and the billions of dollars you've committed to financing and facilitating climate solutions? And maybe you can bring that alive for all of us with an example.
Sure, happy to. So I first of all want to say I love the application of the last mile concept to this discussion. I think it really brings to life this key theme in the financial services space, and I think in the sustainability space, is around integration. How are we integrating these sustainability objectives, integrating certain risk pieces into the way that we do business? How are we integrating the way that we look at value creation, whether it's sustainability value creation or financial value creation? So really want to underscore that theme that Janine raised. And how we bring it to life is, I mean, there's so many different ways. I first want to say that, you know, this interesting dynamic we've seen in our sector. I've been at Citi and in the sustainability space since 2004. You know, Citi's been at it for even longer. I was a second generation sustainability team at Citi. We had some folks before me. And we've seen this pivot in our sector from sort of trying to create this level playing field. Like, we don't want to decline a transaction and then be undercut by another bank that's coming in and saying we can do it even though it's risky. You know, that's not the narrative anymore. We've shifted from, for the most part, this sort of, you know, we're just trying to have a level playing field approach to this crazy race to the top. Like, you know, can Citi be the most sustainable? Can Bank of America be the most sustainable? We actually work a lot together, right? Because this is very much a collaborative effort in our sector. And I think that the way that we use disclosure, the way that we use metrics to bring it to life is, first of all, on the sustainable finance side, you know, under our $250 billion environmental finance goal is a lot of analysis. There's a green taxonomy that we have created with lots of external feedback and we published. There is a whole suite of products. I loved the point that Ewout made about linking finance, you know, linking capital markets to sustainability performance. I think that's a key sustainable finance trend that, not even a trend, it's arrived, right? This is what's happening in the market. And so on the sustainable finance side, we are very much focused on, you know, for every conversation with a client, whether it's a product or strategic advisory, are we thinking through the possible ESG intersections? And we have lots of teams that are, you know, helping to carry this through into client conversations. So it's a work in process, but it is a very different environment than a few years ago, I think, at the banks. And, you know, to tie this back to disclosure, we're asked a lot, like, well, how does your effort here at Citi compare to others' goals and so on? And that's where the metrics start to get really important and where, frankly, we could use more standardization. Different institutions set different goals because they have different businesses. But I think that increasingly definitions are important. Like, what is the taxonomy that you're using? What are your annual actuals toward the goals? What kind of products do you include, and what's your accounting methodology for that? These are all kind of important questions because we're hearing more and more from investors. You know, they want to understand some of the granular pieces. When you have the sustainable finance disclosure and you combine it with good climate risk disclosure, you know, what are you doing with regard to analyzing your clients and their ESG performance? How do they perform in certain climate scenarios? You know, what data are you using to do carbon accounting for your loan books? Then you start to be able to show your investors and your stakeholders how you're helping to how you're transitioning your business to low carbon and more sustainable, how you're helping clients to transition. And that's where I think that you know, this sort of integration into business strategy, into financial strategy, your integration into client strategy, and then your disclosure sort of really, I think, comes in. You asked for a specific example, Steve. It's hard to think of just one, but I will mention, you know, I think a new initiative, relatively new initiative that I think, you know, many of us are involved in is initiative that Citi recently joined, Bank of America did as well, called PCAF, the Partnership for Carbon Accounting Financials, which leverages an industry developing methodology, leverages data around greenhouse gas emissions associated with different clients in different sectors to enable an analysis of the carbon footprint of different clients and different industry portfolios. And, you know, you begin to track that over time, right? You can learn a lot about how your clients are headed. And so that's one initiative that we're just getting underway with, working on data sources, looking at Ewout here, and really excited about the potential for that area of work.
And Steve, can I connect a dot here for the audience? Because I think this is a great example of of potentially initiatives working really well together. So the SASB standards for the financials industry do not right now have an explicit metric around financed emissions. And the reason they don't have a metric around financed emissions is that when we were developing the standards, with the feedback we got from the big banks, so the issuer side, was that there was no agreed methodology. And therefore, because there was no agreed methodology, we couldn't get consensus around a metric to put in the SASB standards. An initiative like PCAF, which would develop an industry consensus around a methodology to measure financed emissions, is incredibly helpful, because then SASB can take that and use that then as a metric in the SASB disclosure standards for financials. So I just wanted, because sometimes because all of these initiatives get described in similar language, it can get very confusing, but they're actually more interconnected than that may appear if you're one or two steps removed. So just wanted to try to help the audience on that.
That was a super clarification, Janine. And I think we all know on this panel, we've got the pleasure of two of the world's leading banking institutions. And Joe, I was going to pivot over to you with the same sort of question that I put to Val, but then also bearing in mind Janine's clarification there as well. How do you cope with the different standards, Joe, as a bank looking at your investment and loan book? What's your reaction to that? And also be great to hear a little bit about PCAF as well.
Sure. Well, I actually try to take it from the other side of the coin as to what Val was saying. I mean, she's absolutely right about the fact that investors are looking very closely at non-financial disclosures and where to sort of address their capital. But we're also getting a lot of clients coming to us because there is an understanding that while, as Janine said, that last mile might not be defined and exactly how your ESG performance or your focus influences your profitability long term, there's understanding that it is happening. And so a lot of companies are coming to us, and not just IBC companies that obviously are representative of some of the biggest companies in the world, but smaller clients, mid-market companies, and saying, hey, listen, I understand that these things are important, not only to my stakeholders, but probably to my financial performance. How can I get into the game, so to speak? How can I start beginning to disclose the things that I know my investors will care about, my employees will care about, my communities will care about, and whether or not that has a causal or a whatever the link is to financial performance. And so that's one of the things that I think is so valuable about the IBC metrics, which are obviously no replacement for the more extensive and really deep metrics that Janine and others like at PCAF and SASB and GRI are doing. But what they really do provide is allow for those companies that are not as mature in this space to come to us and say, hey, Bank of America, hey, Citi, I know you guys do this. I know you do it well, or we hope we do. How can I at least start a direction of travel and start to have an ambition and growth in the sector so that I also can become a leader in sort of the non-financial disclosure space? So I think it's really interesting, the evolution that we're seeing, because, there is an understanding too. People definitely see the writing on the wall that there is maybe eventually going to be a universal global standard. There's no doubt that, regulators are starting to look at this very closely in Europe and probably eventually in the United States. But that's going to take some time. I think people want to get out in front of it. So what we're trying to offer with these IBC, World Economic Forum, non-financial disclosures, at least an on-ramp. So as they work towards being able to disclose along the lines of what we do with SASB or what Citi does in all their various different capacities, that there's at least a path there so that they can demonstrate to all their stakeholders that they're making progress in this area.
That's great, Joe. And I like the way that you've identified for us that this is not just a big company conversation. We've got a lot of small and medium enterprises. And frankly, for the state of many of the economies of the world, we need those small and medium enterprises to drive growth and drive employment, especially as we emerge out of the pandemic. That's a great reminder to us all. Let me pivot again. Let's talk to Ewout. So for Standard & Poor's and in getting ready for this session, you talked about the role of ESG in credit rating, something that's very, very core to your business, and how it's already embedded in your criteria methodologies. I was interested to know what the biggest spread or impact you've seen on a rating as a result of ESG. Bring that to life for us, Ewout.
Yes, happy to talk about that. I do need to say beforehand that we have obviously a very clear compliance distinction between the analytical group that deals with the criteria and methodologies and the leadership and the commercial organization. So I am, of course, not speaking on behalf of the analytical group, but what I can say is that already for several years, S&P Global Ratings is incorporating ESG factors in its assessment of the creditworthiness of corporations, and particularly to take into account if some of those factors are material for the assessment and the opinion of the ability and willingness of a corporation to fulfill its financial obligations. And the question about materiality is an interesting one. I think we probably can have a whole panel to discuss materiality, because there's clearly a lot of new and evolving thinking and learnings about that topic. But those particular elements in credit ratings are, of course, reflected in business risk, in financial risk, in the assessment of good governance and management. But ultimately, I can say that if you look at the stats, the impact is already quite significant. So if you look at the numbers for the period of April to August of this year, the total ratings actions that were triggered by ESG for S&P Global Ratings was almost 2,000 ratings actions, of which 666 were downgrades triggered by ESG factors. So it is absolutely meaningful in the way how those credit ratings come together. And that is, I think, ultimately clearly getting attention for those issuers of bonds. Besides that, also the ratings business, our ratings business, is helping issuers, because not only credit ratings is important, we're helping them also to put out good information and good quality of data. Because the biggest problem around quality of data of ESG is that the most of the data providers only have an outside-in perspective. They do website scraping, they look at it from an outside perspective, and there are a lot of factual errors, therefore, in the reporting of the data. So there is an initiative that we call ESG evaluations, where our credit analysts can sit together with companies management, and they are doing that anyhow already once a year, and is helping them to do this comprehensive review, where it's not only the current ESG performance, but also the forward-looking aspect of what are the strategies around this particular topic, what are the aspirations, what are some of the science-based targets, and helping to put out a comprehensive report that market participants can use, because then this particular company doesn't need to go out to all those data providers and try to correct all those factual errors. So very actively involved from the ratings business in this space as well. And Steve, to your question, I can't give specifically an answer on what's the impact on credit spreads, but the impact on ultimately ratings actions is material.
Thanks, Ewout. That's a material impact. Then is what you're saying. That's sizable for many of the organisations that at least my firm works with, and I'm sure there's clients for SASB, Bank of America, and Citi as well. Thank you for that. Look, everybody, we're pretty much done here. We're pretty much done on the session. It may have taken us 100 years to build international consensus in financial reporting, and even that has its challenges. But given the urgency of climate change and the existential threat it poses, I think we'd all agree that sustainable finance can't wait for the same sort of consensus. So it's encouraging to see so much happening and so much leadership from the four of you as well, especially putting in place these building blocks that I think will lead to a degree of convergence on non-financial reporting. I want to thank all of you as panelists and IIF for this great session today, and an opportunity to talk to you all about this really, really important topic. And I look forward to seeing all of you in the future, and the leadership and delivery of the important topics that we've discussed. So for everybody, please stay online at the top of the hour for the next session today, New Regulatory and Policy Landscape for Sustainable Finance, featuring Judson Berkey from UBS, Sarah Breeden from the Bank of England, and Kevin Stiro from the Federal Reserve Bank of New York. Thanks, everybody. Thanks again to my panelists. See you all soon. Bye now.
Great. Thank you. Thank you, Steve.